Good afternoon, this is Christian Thwaites from Brown Janikowski, Wednesday, March the 16th. We don't often do midweek updates on the markets, but today was an important day. It was the meeting of the Federal Open Markets Committee, and this follows very quickly after last week's meeting with the ECB. And the tone was roughly the same, which is that both banks have been very dovish in their outlook and continuing to be fairly easy in their monetary policy. Of course, the Fed is at least 6 months to a year ahead of the ECB. But what surprised the market today was just how much the Fed is brought down its estimates of growth and down its estimates of how far interest rates will climb. Take a look at this chart. This is the famous dot plot chart, which you might have heard about. It looks a little bit confusing. But if you look on the left-hand side and look at the 2016 column, the second one in, a year ago, this is what the Fed governors thought interest rates would be in 2016. So we've got most of the rate expectations clustered around in this 1.5 to 2.5 area. And then shoot over to the right-hand side with the dot plots which they released today, and you can see they're clustered tighter together and much further down. Most of the governors do not think that rates will exceed 1.5%, and most of them at 1%. And this is a pattern we've seen for a while. It seems that at meeting after meeting, the Fed thinks that interest rates in the economy will normalize, and they're just not doing it. So for now, we think that the rates will be low for some time to come. We don't expect many rate increases, perhaps at the back end of the year. How did the market take this? Well, the stock market closed on its year-to-date high, which was encouraging. That's up 11% from its lows in February 11th. The all-important government 10-year Treasury was about unchanged. We're not really changing any of our estimates based on today's meeting, but it was an important one. Thank you.